What's driving markets? Welcome to Market Take. Each week, we'll bring our insights on the latest market and economic trends that are impacting investments. I'm your host, Glenn Purves, Global Head of Macro at the BlackRock Investment Institute. This week, we share why we're staying risk-on as macro tensions ease and change our views on U.S. Treasuries. We stay risk-on. A softer U.S. labor market gives the Federal Reserve room to cut and eases brewing political tensions from higher interest rates. We think these rate cuts will support U.S. stocks and the AI theme. We also think long-term yields could fall more, even if the pressures driving them up persist, and close are long-standing underweight. Until recently, we saw the economy in an inflation puzzle. Headline inflation had declined, even as U.S. tariffs pushed up on goods inflation. At first, we attributed that to surprisingly weak services inflation. Surprising because the labor market otherwise seems strong. But job gains have stalled. That suggests this cooling services inflation is ongoing, which gives the Fed room to cut. But we stay watchful. It's unclear why the labor market is soft, and rate cuts could spark hiring again while inflation is still sticky. That would reignite political tensions between inflation and debt servicing costs and lead us to take a more cautious risk stance. April's policy-driven volatility hit global markets, but U.S. stocks are among the best performing markets since then, with the AI theme driving much of that performance. The lesson? Immutable economic laws limit rapid policy change. This framing allowed us to re-up risk shortly after the April 2nd tariff announcements. We stick with our risk-on stance and the AI theme, even as the market backdrop has changed. Instead of tariffs and policy uncertainty, the drivers are now tensions between inflation, growth, and government debt. We prepare for a few very different near-term macro scenarios. Our base case, Fed rate cuts boost equities and support long-term bonds. We now close our long-term underweight in long-term U.S. Treasuries to go neutral. We flip neutral on short-term Treasuries from overweight. Another possibility, the labor market weakens more and Fed rate cuts can't offset the pressure on risk assets. In this case, we'd be ready to take a more cautious risk stance. On the flip side, another possibility, a hiring rebound stokes inflation and the spotlight on Fed independence returns. Investors would likely demand more compensation for the risk of holding long-term bonds. Long-term, we stay underweight long-term government bonds and prefer inflation-linked bonds. A softer labor market and slowing growth pave the way for the Fed to cut rates. We think this will benefit U.S. stocks and stay overweight. We close our long-term U.S. Treasuries underweight, but think pressures pushing yields up could persist. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in, and if you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
This material is intended for informational purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities, funds, or strategies to any person in any jurisdiction in which an offer, solicitation, purchase, or sale would be unlawful under the securities laws of such jurisdiction. The opinions expressed are as of the date of publication and are subject to change without notice. Reliance upon information in this material is at the sole discretion of the listener. Investing involves risks. BlackRock does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. For more information, visit blackrock.com/thebid.